Welcome to Credit Mastery Desk. This is research-based credit strategy analysis, powered by FICO methodology, Federal Reserve data, and public bank disclosures. Today's topic: the high-interest business credit card trap, and exactly how to avoid it and escape it if you're already caught. Let's start with a number that should alarm you. Research shows the average business credit card carries an APR of 18 to 24%, but some, they exceed 27%. That's not a typo, that's real. And if you're revolving a balance month to month, you're paying rates that personal cards simply cannot charge legally in most consumer markets. Here's why this matters. Imagine a business owner carries a $25,000 balance on a business card at 22% APR, a realistic mid-range figure. If they pay the minimum, typically 2-3% of the balance, they're looking at roughly $458 per month in interest alone. That's $496 per year in pure interest, with almost no principal reduction in the first year. In 3 years, without aggressive paydown, they'll have paid over $15,000 in interest on that $25,000 balance. The debt doesn't shrink, it compounds. The question isn't whether business credit card debt is expensive. It's why are business owners accepting these terms in the first place? And more importantly, how do we stop it? The FICO mechanism. How high-interest debt destroys your score. Before we talk about paying off the debt, we need to understand how holding high-interest business card balances actually damages your credit profile beyond just the interest cost. FICO scoring methodology breaks down like this. Payment history accounts for 35% of your score. Amounts owed, that's utilization, accounts for 30%. Length of credit history is 15%. Credit mix is 10%. New inquiries is 5%. Here's the trap. When you're carrying high-interest revolving debt, you're usually maxing out or near maxing your credit lines. Data from Federal Reserve consumer credit surveys indicates the average small business with revolving credit card debt maintains utilization rates between 60 and 85%. Compare that to the FICO optimal threshold. Under 30% utilization is considered healthy. Under 10% is optimal. What's the actual impact? A business owner with a $50,000 credit limit carrying a $35,000 balance is operating at 70% utilization. Research shows this alone can cost them 50 to 100 FICO points compared to the same owner with 10% utilization. That's the difference between a 720 score and a 620 score. The difference between business loan approval and denial. But here's what makes it worse. That utilization damage compounds when you miss payments. And when you're in high-interest debt, missing payments becomes tempting. The monthly interest charges eat cash flow. You're forced to choose between paying principal and funding operations. One missed payment, even 30 days, tanks your score another 100 points and resets your payment history clock. Payment history is 35% of your score. Miss one payment, and that recent negative mark carries exponential weight. It signals to the FICO algorithm that you're a credit risk. Future lenders see it. Your business lines of credit may get reduced. Your approval odds for refinancing drop. So the high-interest business card doesn't just cost you money in APR, it costs you creditworthiness. Why business cards charge more than personal cards. This is a critical gap most business owners don't understand. Personal credit cards in the U.S. are federally regulated under the Truth in Lending Act and the Credit Card Accountability, Responsibility, and Disclosure Act, the Card Act of 2009. That legislation imposed strict APR disclosure requirements, limits on rate increases, and penalties for predatory pricing. Business credit cards. They operate in a regulatory gray zone. The Card Act exempts commercial credit from most of those protections. That means a bank can legally charge a business owner 27% APR on a business card, with far fewer restrictions on rate increases, without the same disclosure hurdles. Data from public bank disclosures shows this gap clearly. As of 2024, the average personal credit card APR hovers around 18-20% for cardholders with good credit, FICO 670+. The average business card, 21-24% for the same credit tier. But more dramatically, banks often approve business cards with variable APR that can spike 2-3% within the first year of account opening, legally. So when you apply for a business card at 99% APRA and get approved, you might find yourself at 99% within 12 months. The research is clear. This is intentional design. It's how banks manage the risk of small business lending while maintaining plausible deniability. Asterisk, the 70% APRA strategy. What actually works, okay, so you're either carrying high interest debt now or you want to avoid it. The most researched strategy for business owners is the 72% APRA balance transfer card. As of Q4 2024, research shows several business cards offering 22% APRA on balance transfers for 12-18 months. Here's what the data indicates about this strategy. First, the window matters. Most 60% balance transfer offers come with a 12-month to 21-month runway. That means you have 12-21 months to pay down the transferred balance at 26%. After that, the APRA reverts, typically to the card's standard rate of 18-25%. Second, balance transfer fees are mandatory. You cannot transfer $25,000 balance for free. Research shows most business cards charge 2-5% balance transfer fees. So $25,000 transfer costs $500 $250 upfront. That's built into your payoff target. Third, the math has to work. If you transfer $25,000 at a 3% fee, $750, you owe $25,750. If you have 12 months to pay it down, you need monthly payments of $146 to hit zero before the APRA resets. That's the cash flow requirement. If you can't commit to that, the 61% offer is a trap. You'll carry a balance at high APRA again. Fourth, utilization still damages your score during the 27% period. Even at 48%, carrying a $25,000 balance on a $50,000 limit is 50% utilization. Your FICO score will dip during this period. Plan for that. But here's the research-backed reality. If you can commit to aggressive payoff during the 76% window, this is the single most effective strategy for escaping high-interest debt. The numbers are stark. Take that $25,000 at 22% APRA we discussed earlier. Over 12 months of minimum payments, you pay $5,496 in interest. Over 12 months of 69% with a $3,000 balance transfer fee, higher estimate. You pay $3,000 total. That's a $2,496 advantage. Over 24 months, the advantage grows to $5,000 plus. Asterisk, consolidation vs. negotiation. The data not everyone qualifies for 56% balance transfer cards. FICO scores under 650 make approval unlikely. In that case, research shows two viable paths: consolidation or negotiation. Consolidation means taking out a business loan to pay off the credit card debt entirely. Federal Reserve data shows small business loan rates average 7-12% for borrowers with established credit. That's roughly half the business card APRA. The trade-off: you're extending the payoff period, typically 24-60 months, so total interest paid can still be substantial. But monthly cash flow improves dramatically. Example, $25,000 at 22% APRA, paid over 36 months with minimum payments, costs roughly $8,000 in interest. The same $25,000 via a 9% business loan, paid over 36 months, costs roughly $3,500 in interest. That's $4,500 saved. The approval requirement is typically a FICO score of 650 plus, 2+ years of business history, and documented cash flow. Negotiation means calling your bank and requesting a lower APRA or hardship reduction. Research from the Consumer Financial Protection Bureau shows success rates of 30-40% when cardholders negotiate directly. Banks would rather reduce your APRA to 15% than lose you to default or competitor cards. The key is positioning. You need cash flow proof and a competitive offer from another bank. I have an offer for 18% APRA on a balance transfer card is leverage. The data shows negotiation works best when 1. Your account is in good standing, no missed payments in the last 6 months. 2. You've held the card for 2+ years. And 3. You're requesting a rate reduction of 2-4 percentage points, not a massive cut. Asterisk, the payoff priority. Which cards first asterisk asterisk? If you're juggling multiple high-interest business cards, the research is clear on which one to attack first, the one with the highest APRA. This is mathematically optimal. A $10,000 balance at 24% costs $2,400 annually in interest. The same balance at 18% costs $1,800 annually. That $600 difference is real money. Prioritize the 24% card. Pay minimums on the 18% cards. Focus fire on the highest APRA card until it's eliminated. Here's the psychological twist. Some financial psychology research suggests the snowball method works better for behavior change, paying off the smallest balance first, regardless of APRA, to build momentum. The data on which works better is mixed. FICO-optimized payoff says highest APRA first. Behavioral research says smallest balance first. The real answer: pick one and execute it. Consistency beats optimization every time. Count age is also crucial here. FICO methodology weights account age at 15% of your score. If you have a business card you've held for 5 years, closing it, even after you've paid it off, costs you credit history. Research shows closing cards reduces average account age, which can drop your FICO score 10-15 points. Strategy: pay off the high-interest cards, but keep them open with $0 balances. The oldest cards should be the last closed. Asterisk asterisk, the prevention framework. Avoiding the trap asterisk asterisk. Lastly, if you're not in high-interest debt yet, here's what research shows about prevention. First, separate business and personal credit from day one. Don't use personal credit cards for business expenses. This creates mixing that tanks your personal credit score, which affects your ability to borrow personally if your business fails. It's also a tax and liability nightmare per IRS guidance. Second, establish a business card strategy before you need emergency credit. Applying for cards when you're desperate means you'll take whatever terms you're offered. Proactive applications, when your business is stable, mean you can be selective. Approval odds are higher, negotiating power is stronger. Third, set a utilization rule. Never exceed 30% of any card's limit. If you have a $15,000 limit, your spending ceiling is $15,000. This is not advice. This is FICO optimization. Staying under 30% preserves your score while giving you flexibility. Fourth, build a cash reserve equal to 60 days of operating expenses. Research shows businesses with this reserve don't panic borrow when cash flow dips. They don't max out credit cards at 24% APRA. They tap their reserves, then replenish them. This single practice eliminates the high-interest debt problem for most small businesses. Fifth, monitor your APRA quarterly. Set a calendar reminder. Check your card statements. If your rate has drifted upward without notification, which happens, call and negotiate. Banks count on you not paying attention. Asterisk asterisk, the bottom line asterisk asterisk, high-interest business credit card debt is expensive. It's also common. Research suggests 40-50% of small businesses carry revolving credit card balances. But it's also escapable. The strategies that work are 24% balance transfer cards for those with credit scores above 650, consolidation loans for those with stable cash flow, negotiation for those with established accounts, and the highest APRA first payoff method for those with multiple cards. The real cost isn't just the interest paid. It's the FICO damage, the cash flow stress, and the psychological weight of carrying debt. Escape it. Your credit profile is your leverage. Protect it. If this analysis opened your eyes to something